Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending September 9, 2022. All the major US and Canadian market indexes were up for the week, as well as gold. Oil was down by a small amount for the week. The stock market had a great run from Wednesday on as interest rate hikes are expected to be somewhat tempered. Volatility and worries in the market are likely to continue, however, at least until September 21st, when the US Fed has an interest rate decision. The markets were waffling somewhat for the last 2 weeks because they were pricing in and assuming that the central banks would reverse course in 2023 and start cutting interest rates and avoid a recession and lower demand. Jay Powell, in his 8-minute Jackson Hole speech, caused the market to rethink this with his fight inflation message, which is why the September 21st meeting is so important. CEOs are still using supply chain issues and COVID as a reason for an excuse for underperformance, by the way. On Wednesday, the Bank of Canada has raised its interest rate by 0.75% to 3.25%, as expected, getting us into restrictive interest rate territory. Bank of Canada is saying there are more raises to come to counter inflation. In Canada, CPI inflation eased in July to 7.6% from 8.1% because of a drop in gasoline prices. However, inflation excluding gasoline increased, and data indicates further broadening of price pressures, particularly in services. The bank's core measure of inflation continued to move up, ranging from 5% to 5.5% in July. Surveys suggest that short-term inflation expectations remain high. The longer this continues, the greater the risk that elevated inflation becomes entrenched. This may be just Bank of Canada, quote unquote, jawboning inflation lower by setting the expectations they'll raise more, which will cause the demand to go lower all on its own, and they won't actually have to raise the rates as much. The trick will be to know when to stop raising rates to avoid a recession, that is, to have a quote unquote soft landing. Most experts believe we've seen the peak inflation and that getting it to come down from its current rate to 4 or 5% will be relatively easy, but from there down to 2% will be the hard part. Consumer confidence in Canada is still poor, mostly due to the highly visible inflation. Until recently, falling gas prices and falling real estates were showing lower inflation, as did the CPI reports. Turning to world news, on Tuesday, Russia cut off gas to Europe by cutting off the Nord Stream pipeline, wanting the European sanctions lifted. Natural gas flows are down 89% from last year. There are very high electricity and energy prices in Europe in general. If Russia cuts back exports, oil could come up significantly, and Europe could have a tough winter. OPEC has cut production slightly instead of increasing by the 100,000 barrels they had promised, but on Tuesday, oil prices still went down. Europe is having energy issues. Today, between alternative and nuclear, they can only cover 25% of their energy needs, and oil, coal, and natural gas covers the rest. As Russia has cut off the natural gas flow, it will cause Europe hardships and high prices for energy if the Russian energy is not on the market. The UK will cap energy prices and end the fracking ban on oil drilling. The US nuclear deal with Iran, which was supposed to be able to bring 1 million barrels per day to the market, is being delayed. When the news first broke, it was made clear the deal would take months to finalize, even though the price of oil still went down at the announcement. Oil prices are down because of fear of recession in Europe, recession in China due to their lockdowns and real estate sell-off, and US dollar strength. Looking at China, it had cut its interest rates over the previous weekend by 2% and are seeing more COVID-related closures. Experts think the zero COVID policy will disappear in China by the end of the year. Now to conclude with some bits and pieces. The expected increases in interest rates affect growth stocks the most, as they did in November, because of the discounted cash flow model that a lot of experts are using to evaluate stocks. As inflation comes down, growth stocks may start to look viable again, since interest rates will come down as well, or at least stabilize. This past week, European Central Bank had raised its interest rate by 0.75% as well. On Thursday, the weekly US jobless claims came in at 222,000, the lowest since May. There are two big upcoming dates that everybody should be aware of. September 21st is the US Fed interest rate announcement, which will be quite important. And on October 16th is the Chinese National People's Congress, where big decisions will be made for China, and it is likely that the government will try to keep everyone happy until then. Looking at next week, on Monday, we have earnings from Oracle, and on Thursday for Adobe. On Monday and Tuesday is the OPEC meeting, which may shed more light on their oil production and determine supply, and therefore the price. The US is releasing 1 million barrels per day from their strategic reserve, which is keeping the prices down somewhat, but will eventually need to be refilled and increase the price at that time. On Tuesday is the US CPI, which will be an input into the US Fed meeting and announcement on September 21st. On Wednesday is the US Producer Price Index to see what inflation there is for manufacturing. So that concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.